Hey guys, so I thought it was about time I share with you an update on my ISA portfolio. We're nearly at the halfway point through the year, which is crazy how fast the year has gone, and I thought it's quite a good time to share an update. I know the market so far this year has been pretty rough. I'm sure most of you are either not looking at your portfolios or you're checking every day and having a panic attack, so I thought why not share you my portfolio and it might make you feel a bit better. I really like to do these because I think as well as teach you about investing, I need to be as transparent as possible because I really want to show you that I'm doing it too. If you appreciate the honesty, do take a minute to smash that like button because it really helps the channel grow. So I'm going to show you my whole portfolio, what I'm holding, and share my general thoughts on the market as a whole and what I plan to do going forward. So my ISA portfolio is still with free trade. I know I recommend Invest Engine, but I have a Russian ETF that I can't sell, so I couldn't actually leave free trade if I wanted to. I haven't actually added any money to my ISA this year, so I've still got my 20,000 allowance ready to add. I haven't done it so far because I'm probably going to buy a property this year, and with the prices being so high, I've just got to wait and see what happens. So this is my ISA portfolio. I do have my SIP obviously over on Vanguard, and I'll have an update on that one coming soon. If you don't want to miss out on these updates, make sure you subscribe and turn those notifications on. Before we dive in, I do have to make a quick disclaimer and just say this isn't financial advice. This is just what I'm doing. Please do your own research and make your own decisions. My balance as of today is at £107,933. And you can see I'm actually holding what looks like 6 positions. And you might think, whoa, there's only 6 positions, but just remember, I do have 2 ETFs in here. Even the FTSE 100 does have 100 companies in it across different sectors. So the portfolio is more diverse than it looks at first glance. The other thing I have to mention, these results are actually quite skewed. I'll talk about that more in a minute, but I did move over from Hargreaves Lansdown, so these results aren't quite that accurate. So first up, I've got my FTSE 100 ETF, and this is the ticker symbol HUKX. Now I went for this one because it had low fees and it paid a really good dividend, and I've done well with it in the past. So with this one, I'm actually up 10.19% and I've made £3,000. Now this one is a little bit inaccurate because I did make 10 or 20% before when I had it with HL. And this actually pays a 3.57% dividend. And if you look over the timeline, you can see how well it's done since the market crashed. I actually bought it, I think even right back down here, about March 2020. So I've done incredibly well with this one. So the FTSE 100 ETF is quite an interesting one. It's made up of quite solid UK companies, which are the big giants, which to be honest, don't always move that far. And that's why the ETF has such a good dividend. Now there's a couple of benefits in owning a FTSE 100 ETF. First is that we're not open to price changes in the dollar. That's because the ETF is in our currency. Second is while it doesn't have that huge growth, I bought it because actually it was down after coronavirus and things like Brexit had happened, and I thought the UK would recover, and it has, and it paid off. But while we don't get that explosive growth going up, we also don't get as harsh of a fall coming down. So whereas the S&P 500 has been tanking, the FTSE is actually looking really good. We are on the brink of a recession that's going to be coming, which will affect everybody, but when you look at the graphs, it's actually quite interesting. So if you look at the price of the FTSE at the beginning of the year, it was nearly 7,500. And the price today is also nearly at 7,500. So it's barely down since the beginning of the year. Whereas you look at the S&P 500 on the other hand, it's down about 15 to 20%. But obviously the downside of this, if you look over a long period, the FTSE has stayed quite static or gone up a little bit, and the S&P 500 has literally gone up like Mount Everest. I suppose a question on my mind now is how much further can it go? The FTSE is close to its all-time highs yet again, and the question that comes is how much growth is there going into the future? Next up, we've got Taylor Wimpey, which is one of my favourite companies, that's TW, and with that one, I've actually made a loss of 9.16%, which is £2,900. Now again, I've actually made money with this one before I moved it over, so I've only picked up this again recently because I kind of dipped out the position. I think I sold it around 20% profit and I've rebought it recently because I feel like the company's come back down to a good value. And I also hopped in right before that huge dividend, which is currently at 6.82%, which is huge. So Taylor Wimpey is a really interesting one. It's a big house builder here in the UK, for those of you who don't know. And they build kind of middle of the road houses, but they also do a lot of affordable homes, which is really good. The company has been hit hard by supply issues, the cost of materials going up, and to be honest, they've kind of come down quite a lot since the start of this year, which is quite a surprise because houses are in such demand. Now there's a lot of pros and cons when it comes to this market. Yes, inflation is going up, which should make houses harder to buy. Yes, we've got supply chain issues, but that might get easier. So it's kind of hard to know which way the market will go. A lot of people are saying that prices will fall. On the other hand, there's just not the supply to meet the demand. But the reason I like to pick these up, I think they're down way more than they should be, and I'm buying it based on the company's fundamentals. It's a really good management team and they've grown the company very well. If we take a look at some of the analysis, here's a tool I like to use, which is simply Wall Street. I'll leave a link down below if you want to check it out. I really like this tool because it's so visual and it's way easier to look at than all of the others. So we can see that Taylor Wimpey is actually trading at 52.8% below the estimate of its fair value. And its earnings are forecast to grow 10% per year. And its earnings grew actually 156% over the past year. Now it says it has an unstable dividend track record, but to be honest, I've had a dividend the whole time I've held it. We can also see some nice figures like the EPS growth forecast, and we can see the trend is going upward. And what I also really like, we can look at the debt to equity, and we can see that while the equity is going up, the debt has stayed quite stable. They actually have a lower PE ratio at the moment than a couple of the competitors, there's Persimmon and Berkeley Group. So really, they're at a good value, they're a good management team, and the dividend is amazing. Definitely one I'll continue to hold and keep collecting that dividend. I'd actually be tempted to put more money in if I had more cash available. Next up, we got Aviva, which is one of my favorite companies again. That's ticker symbol AV. And with that one, I'm actually down 15.93% and I've lost 4,865. And that one's got a really nice dividend yield of 6.77%. Now again, these are really inaccurate, which is so frustrating. Aviva's actually been my biggest gain and I've made £20,000 to £30,000. Now the reason it looks this bad is I've actually done a share buyback, which has dropped it back down. So if I show you in my activity, it's recently just paid out the dividend as well. So I've had the share buyback of 7,902 plus another dividend of 1,142. So between that, I mean, that's literally nearly like £9,000 back. And as well down here, you can see I've had my Taylor Wimpey dividend of 688. So let's just say May has been a really nice month for dividends. Now Aviva is one of my favourite companies. They've done this huge share buyback, which to be honest, you shouldn't be that worried about. They just want to return capital to investors. They've actually returned 4.75 billion, which is crazy, and the company has been steadily increasing in growth, and a lot of that is to do with business insurance growth. Now I know Aviva is quite a boring company, they're not an exciting tech stock, but they're very reliable and the dividend I've been paid out has been my biggest so far. I think holding this company, just collecting the dividends, is not a bad shout at all. Next up, we've got my Russian ETF.
The one that should not be named.
HIUB. So this one, I've actually got £7,000 in it. It's down 70% and I'm down 60,476. Yeah, that was good. So you might think, how did I do that? If you haven't seen my video, I bought before the war started. Didn't think a war was actually going to happen. I thought it was just going to blow over. And yeah, that's the result of it. You can see how ridiculous the dividend looks on here, 28%, which is crazy. I actually did have a few dividends, but it's always been around 5%. That figure is just completely wrong at the moment. See with this one, I can't actually buy or sell it. I'm just going to have to wait for the market to properly reopen. Hopefully this ETF is going to use its trackers to stay on pace and fingers crossed it will recover. I bought this with a timeline of thinking I'll hold it for 10 or 20 years, so I just need to bear that in mind. So my lovely Russian ETF, you can see here is a point, the 5th of March, when it stopped trading. I did buy on the way down, which will hopefully help me in the long run, but at the moment I'm not able to do anything. The whole situation is a bit weird. They reopened the stock market for a certain period of time. They've been buying more gold. They've got huge reserves of gold and different currencies. The price of their currency has actually gone up and their inflation is coming down, which is crazy. The price of the ruble to the pound, the ruble is very, very strong. And the stock market has started to show signs of recovery. And it does kind of make me think, yes, we need sanctions on them and we need to stand by Ukraine. But you kind of wonder, these sanctions, are they hurting them or are they kind of hurting us? We seem to be the ones going into this big crash and losing loads of money. We're paying through our teeth through gas prices. And it wouldn't surprise me, I know I shouldn't probably say it, if kind of Biden and our government aren't really quite as clever as what they're doing. I don't think war's clever by any means, but you just wonder what is actually going on. I've kind of reached the point with it where I've just had to stop looking. I mean, I could drive myself insane looking at every day the news on the war and just think, oh, I mean, it's such an awful situation. I've kind of just reached the point where I'm going to have to just wait and see what happens, stick to my original plan. I didn't think a war was going to happen. There's nothing I can do to change it, so we'll just have to see what happens, but fingers crossed. Next up, we've got a couple of my favorite companies. The first is Alibaba. So Alibaba, I'm actually down 40% and down 1,507. I actually bought Alibaba when it was down quite a significant amount, but if you look how much it's dropped recently, it's just fallen off a cliff. I think I actually bought it when it was already down like 50 or 60%, and now it's down even more. I mean, it's now worth $82 a share, and it was worth right up to $300 per share, so it's fallen off a cliff. This one will be an interesting one because it could come back up in the future and may be worth holding for the long term. This one and the next company I mention are ones I think are probably worth a punt. Alibaba's another weird one. Their crash has been mostly due to kind of their government. And it's been China cracking down on these tech stocks. And there was also another company linked to it that if that went bankrupt, it would affect spending in China. And that was to do with a lot of mortgages going to default. So they were thinking if that goes down and the government doesn't save it, then it's going to have a huge knock-on effect on Alibaba. Alibaba actually reported they have a crazy number of active users, over 1.2 billion, which is just mind-blowing, and the company has been growing year on year. It's kind of the go-to for most of the people buying from the UK. I know I used to buy from there when I had a shop, and I can't see them going very far. It was interesting that Charlie Munger actually invested into this company after I bought it. That's Warren Buffett's buddy, if you don't know who he is. He actually sold 50% of his stake for a 20% loss, which was kind of questionable. We don't know whether he was forced into that. I'm not 100% sure if that's been cleared up now, but it's a good sign that he believes in the company too. The amount that company is down, I don't expect it to be a quick recovery, but it's not a bad punt for the long term. So the next one is another company where I buy all of my stylish designer clothes, which is Boohoo. In Boohoo, I've got 1,761 and I'm down 55%, which is a £2,200 loss. Again, I bought this company when they were down quite a lot, and they've gone down even more, which is no surprise there. Boohoo's a really interesting one. For those of you who don't know, it's fast fashion. So they own Boohoo, they've also got Pretty Little Thing, Coast and Oasis. Now Boohoo and Pretty Little Thing are the ones that have grown like crazy, and the reason they're struggling so much at the moment is because it's fast fashion. So when a new style comes out, they literally design it, get it made and get it out there ASAP. But of course, when they've got supply issues coming in from China, it's not that easy. They've also got things like the rising cost of inflation, which is squeezing their already tight margins. So it's not going to be an easy road for them. They also had some questions about their ethical practices and the staff that they're employing. I don't know whether that's had a huge impact on the price as much as their supply issues, but it's worth mentioning. I'm not completely sure whether I think cheap clothes and ethical practice really go hand in hand. Probably the thing we need to note is realistically we should be paying more money for clothes. But the question is, where do you buy that from? Are some of these designer brands actually paying more to the workers, or are they just overinflating the prices? If you buy any good clothes brands that do support the workers, then let me know and I'll check those out. Also, the sister of the CEO actually sold some of her shares. I wouldn't be too worried about that. She might just want the money for other purposes. Analysts don't seem to be too bothered, so I'm not bothered either. The earnings are actually still estimated to grow 43% per year. I kind of have a love-hate relationship. On the one hand, I like getting cheap, cool clothes, but on the other side, I do kind of think they've probably killed our high street. And that's why some of our town centres are just filled with cheap, crappy shops or boarded up windows. So overall, that's how my portfolio is looking. To be honest, it has dipped massively because of that Russian ETF, which is great, but especially when I look at my performance and I see, right back up here, I was nearly at £130,000, then going right down to nearly £100,000 was a bit of a shock to the system. But that's all part of investing and part of the journey. What you have to do is keep reminding yourself that when stuff's down, it's the best time to buy. And that's really how I was able to generate such good returns in the past crash. If we look over a 1-year period at the market, I'm actually down 10.82% and the All World ETF is up 0.56, and this is a benchmark that free trade puts you against. But if we go in a shorter time period like the last month, I'm actually up 1.22% and the market's down 4.34. So I'm about 5% up on the market, and that's a lot to do with the fact I'm in such solid UK companies. The Russian ETF has just kind of crushed me this year. If I hadn't bought that, I'd be in a really good position now and I would have outperformed the market. So what am I thinking and where am I going from here? Well, what's quite interesting is when I looked at my portfolio, When you look at my top holdings, I've got Aviva, the FTSE, Taylor Wimpey. They all pay a 6, a 3 and another 6% dividend, which averages at 5.72%. Now actually, with the current state of the market, considering it's probably going to drop some more, having that nice dividend and very stable companies doesn't seem like a bad way to go. I'm quite tempted to actually pick up more UK companies I think are undervalued, because I think there's actually quite a few at the moment, and I might put a video out about the ones I'm thinking about, but it does seem like there are some good opportunities to be had. And to be honest, I'm not far away from having a 100k dividend portfolio, so I'm thinking, do I just build a dividend portfolio? Would that be quite interesting to watch? I don't normally go for dividends, I'm really interested in growth because I'm in it for the long run, but at the moment, while the S&P 500 looks like it's going to tank, then maybe I should just focus on dividends. It would be quite nice to see that monthly income come in every month. The ones I've had in the last month have been so nice to receive. And I do have my SIP, which is the S&P 500, which is kind of the contrast to this. So while that one's going down, this one's actually done pretty well. What was really interesting, I know this isn't the most accurate figure to look at, but when you look at the last crash, it actually went down 31%, and the market so far has only gone down 18%. And we're on much higher a cliff than we were back then. Personally, I'm expecting the market to go down at least 30 or 40% from them all-time highs. So I think we do have some way to go. So let me know what you think. What do you think about my portfolio? How do you feel about yours? Is there any companies you think I should be buying or selling? And as always, I hope this was useful. If it was, please press that like button and let me know down below if you'd like to see these more often. Thanks for watching, guys. Good luck on your returns, and I'll see you in the next video.